Hello and welcome to BloombergQuint. Today we're discussing what has come out last night. That was the KV Kamath report on how corporate India or banks that deal with corporate India can actually restructure the loans and try to come up with a better restructuring scheme following certain specific financial parameters that the committee has recommended. And then for each of those parameters, of course, the committee has also suggested benchmarks that need to be followed whenever banks are coming up together to create the resolution plan. To discuss this in greater detail, we're joined on the call with Mr. Arijit Basu. He is a managing director at State Bank of India. Mr. Basu, thank you so much for taking out your time and joining us. I realized that the report came out later last night, and then probably bankers are still, getting a hang of what exactly the committee is trying to tell them. But to start with your initial views as far as the report and its findings go.
Yeah, thank you very much. So the committee was expected to look at the primarily 3 or 4 areas. One of them was to look at which sectors need to be, assisted in the corporate sector.
Yes.
When banks consider the restructuring package. If you were to recall, the RBI themselves had said, given the broad outlines of what the restructuring package could be, that this could be for a period of 2 years and so on and so forth, and up till when a person can apply, what would be the mandatory timelines, and they had also linked it to the 7th June 2019 circular. The remit of this committee was to give and find out what would be the ideal financial parameters that the banks need to keep in mind when going in for this, and which are sectors which are really in need. So they have come out with the report. It is very much on expected lines as far as we were concerned. We knew that these were the sectors which had got impacted, and we welcome the fact that they have come out so fast. They have done very comprehensive they have provided clarity, and now as things unfold, it will be taken forward.
Right. Mr. Basu, as part of the report, they've mentioned 5 basic benchmarks to look at. And then, of course, within those benchmarks, there are thresholds set. Just trying to get a view, do you think that these 5, that is total liabilities over adjusted net worth, current liabilities, looking at the debt servicing ratios, do you think that gives you a fair picture of A, where the company stands, and B, whether this company can recover from the stress that it is in currently?
Absolutely. So when we do any assessment, there are 2-3 things that we see. What is the leverage? What is the debt that the company has taken, and what is its liquidity position? And these are the 4 or 5 key parameters that any bank at any point of time actually looks into. So they have looked at the total debt to EBITDA, the total outside liabilities to the adjusted tangible net worth, adjusted for any kind of investments that they might have made. It would be the total debt to EBITDA for liquidity, this current ratio, and whether they have, after the scheme is over, whether they have adequate debt service coverage ratio, and both at any point in time and also average over the period that the restructuring may be done. This is always the case, even for a normal loan that we give, we look at these parameters. So these were very much expected.
What else? I mean, the committee in its report said that apart from this, of course, the lenders can look at some other parameters to judge the restructuring of a company. What else do you think would be key to find out whether a company is capable of coming out of the stress?
We would have to look at the industry that they are in. What is their equity that they have already brought in? What are their business plans? What are their profitability margins? What would be their interest coverage ratio? But very frankly, if you look at these 4 or 5 key parameters, they actually have a link to any of the other ratios that I would have mentioned. So from that aspect, it would be a comprehensive thing, and each company would probably requirement the ones who will actually come forward for restructuring.
Right, I understand that, but one view amongst analysts who later today put out their views on the whole subject was that some of these parameters that have been suggested are so stringent that there might be companies which may not be able to meet it, and then eventually may come to the bank saying that this restructuring scheme is clearly not working for us, so let's just go with June 7th. Do you think that scenario is likely?
I would not think so. As of now, I can speak for my book. I would not think so at all. Number one, if you see, they have made adjustments for various industries. I think for aviation, for example, I recall that for TOL, TNW, they have given a much higher TOL, TNW that could be looked at because of the circumstances that they are in. And the range that is given is fairly liberal, I would say. The TOL to outside, it's less than 6, total debt to EBITDA 5.5. And these are not things which a company should not be able to meet. Of course, we can set benchmarks for it. You have to reach these ratios after 1 or 2 years, by March 22 or March 23 in some of the cases. And in between, you would need support. So for companies which would need support, I don't think that these things which will come in the way. And unless you have a debt service coverage ratio of more than, how will you be able to repay the debt? That means there is some other fundamental problem in your business model.
Right, and that brings me to the next question, because last few restructuring schemes that have come out, the assessment is that they didn't really work in terms of addressing the stress in the system. Now, I'm not talking about COVID, of course, that is a completely different problem that came up. But even before that, there were companies that were not being able to actually thoroughly restructure and repay their debt on time, even after getting the support from the banking system. How do you ensure that this does not go down the same route?
No, see, it will depend on the sectors have been identified. No, now it comes to actual practical, each bank will have to do its own assessment of each of the companies, which I'm sure that each bank is doing. Now, I can speak only for SBI. I have a complete idea of how we are placed. Okay, so even as on 30th March, and we have repeatedly said this, and COVID has not significantly changed that. As on 30th March, the quality of our corporate book had significantly increased. And this we have shown by way of the accounts which are in even SMA, even if we leave out, had significantly reduced both in terms of the number of accounts as well as the number of the amount of which is under any kind of default, even for 10 days or 15 days. Right. And post-COVID, our moratorium ended on 31st August. Most of these companies were not even if they had applied for moratorium, they did not avail of it. So what would happen is that it would depend on the actual stress which each company is subject to at this point in time. Now, the companies themselves would also be very cautious. For example, as far as SBI is concerned, as of now, there is nothing new which has happened in the last 8 days. I can confirm to you. But yes, we know that there are companies, and I can also confirm that there are no large company for SBI which actually would be looking forward to it, as per our understanding at this point in time. Because yes, COVID impact, how long it goes, we do not know. As of now, the moratorium has been lifted. The economy is slowly opening up. In future, there could be some other thing, but at this point in time, there are not many accounts in SBI, and certainly not very large accounts which would need this. But if they do need that, we will have to examine very closely, and both sides have to work. The company also has to understand that if there is any fundamental change that they need to do to their business model, etc., that needs to be done. But for certain sectors like tourism, trade, aviation, these appear to be temporarily impacted. Textile also, because textile sales have gone down. And once there is a solution to COVID, these sectors will be able to come out. But for SBI, just to give you a sense, since you are talking to me, what the good thing for SBI is that we have been able, even in these stress sectors, the companies which are in our books are very strong. By and large, almost the entire book is very strong, which is why at this point in time, we are not anticipating much. As we have said earlier, when our 30th September results will be declared, you will get the first indication that how many companies had to come forward for restructuring, because even in 1 month itself, that is from 1st to 30th September, they could not repay the bank's office. But you will get a fairly clear picture by the end of December. And as far as we are concerned, we are not expecting a repeat. To go back to your question, we are not expecting a repeat only because the companies which are in the books of our bank are starting from a position of strength. They have not, they have conserved some of the mistakes that they had done in the past of depending on over leverage, expansion, unrelated expansion, all those things they have themselves avoided. So in such a scenario, when they have coming forward to the bank for some kind of assistance, they are doing it only because of the impact of COVID and not for any other reason. So it may be easier for them.
Okay. So when the last quarter's results had come out, the chairman at that point in time said that about 13,000 crore worth of loans are there, which are potentially the NPAs that are there on the book. You could eventually see, and even among them, there might be some kind of recovery. Are we still sticking to that outer limit of potential stress?
As of now, the position, in fact, has improved.
It has improved.
It has actually significantly improved. There are one or two reasons for that. We will not get into any details of companies, but I can just give you a flavor why it has improved. One important thing is the power sector. The payment, the government payment that have happened, this 90,000 crore, which was part of the government package, which came through PFC REC, has flown directly. These were basically DISCOM overdues, which were not the companies, the power generators were not able to get, right? So those companies have now got it. And there were one or two large exposures we had, and they are now, in fact, in a mood to prepay. Okay, that is how it has gone. Then for SBI, at any point in time, sometimes you have some large exposures which cause concern. Even without COVID, there was one large exposure in the FMCG sector, which is getting resolved in a different way. There could be one other company. So what has happened, these large exposures, as I was sharing with you at this moment, the largest exposure is of a very small amount. Okay.
Right.
If we are looking at a few companies, number one, we are looking at very few companies, and even within them, none of them have approached us so far formally. We know that they need to come because of the financial condition, but they are all small companies. The large exposures have actually come down, which is why it gives us confidence. The number that you mentioned that our chairman had stated, that was because of some of these large exposures, which
are now looking better.
They see,
yeah.
So SBI looks good. Yeah.
One question that I wanted to ask with respect to the new restructuring scheme, the RBI pushes this sort of working together amongst the bankers in the country, because in the past as well, we've seen that happen with JLF. We have seen that happen with other schemes where when you put a bunch of bankers in the room, things don't really move that fast because everybody has their own profit concern to look at. Do you think that the provisioning limit that the RBI has put, if you do not sign the ICA, you need to pay 20%? Is that a big enough deterrent, or is it better for a private bank or any other smaller bank to just make that provision and not really participate in the process?
Yeah, it all depends on the kind of exposure that they have. Even when a private bank, we have seen when they have a significant amount of exposure, they do tend to try and fall in line, because they know that the downside of not falling in line is that they can take a big enough hit. It is the propensity to not fall in line happens when the exposure is very small. That's the first thing. The thing is that you are right, for the larger exposures, this has been a problem, So for 1,500 crores and above from the banking system, I think the Kamath Committee will be in place for 1 more year. So they will just see how the process is carried out. Personal sense is that the issues will remain. You did ask whether 20% is an adequate enough deterrent. It depends. If the policy of that bank is that in upfront, if I see a problem, I do a 50% provision and all, then this would not act as a deterrent.
Exactly.
But my sense is that most banks would cooperate. And the threshold that has been kept by RBI when they announced on 7th of August is that 75% by way of amount and 60% by way of number is the consensus that the banks can have. And for large exposures, I think most banks will see sense. In fact,
how do you deal with dissenters then? How do you ensure that dissenters do not create problems?
Yeah, so that has been given that in case they can take the what is called the liquidation value. So when for a bad asset, the first thing that is done is if they are not able to service their debt, you find out what the enterprise value is, and there is a way to find out the liquidation value. So then they have to take the liquidation value and go.
Is that enforceable? Is that enforceable?
Sorry, just one more point.
Sorry, yeah, sorry, I interrupted.
Yeah, no, not at all. So if they have some security which gives them that comfort, then obviously they will try to enforce the security. But if they do not have security which is either at par or better than the consensus or the large number of banks, then it doesn't make sense for them unless they just want to get out of it. Then they have to take that liquidation value and go. This is being used in, we have tried it in the IB.
Got that. Lastly, sir, about 11% of your book, as the last number that was mentioned, 11% of your book was under moratorium. I don't know what the current number is looking like, but what portion of that do you think will end up with restructuring?
So two things. I think this 11% or 10% number you are saying is for the bank's entire book, not just corporate. So I'll just divide it. As far as corporate is concerned, again, I'm stressing, as far as September quarter is concerned, it will be very, very good. Good in the sense that we are not expecting any major slippages. We are not expecting any major defaults. And these are basically a company will come for restructuring only when they are defaulting either in payment of installment or interest, which we are not foreseeing, at least in September. Even in December, the way we know our book, we don't expect a major surge, but I would not comment much in advance. So corporate, the book will really looks good or looks stable at the moment. But for the others, as you know, it is P segment and MSME. These are the two remainder ones. P segment, we have again emphasized that for SBI, the primary P segment borrowers are not only salaried individuals, they are majority and preponderant majority of them are government salaried employees who have not been impacted so badly, who will not be impacted so badly because of COVID. So while many of them, because the moratorium was offered, some of them did avail of it, we are already seeing signs that they are coming back and making the repayments, because many of them have now understood that there is a downside also to not paying up upfront. MSME, I think many of them need assistance. But again, to give you an overall sense, we are expecting both slippages and application for restructuring to be much less than perhaps what is being talked about in some of the figures that we are hearing for the banking system. So SBI plays an important part of the banking system. At least for SBI, we can say that it is not in the same range as what is being talked about, at least for September.
Got that, sir.
I would not like to comment so decisively on the MSME
rest of the system
personal book, but in the corporate book, which is what the Kamath Committee is all of, I can say with fair amount of clarity, now that we have gone through one more week of this opening up after 31st August. That is, the moratorium is now over. So going by that, we feel it would be manageable.
Are we likely to see that scheme to be out in the open by the 15th of September, which is what the finance minister seems to have said in the last meeting?
Right. No, finance minister's concern was, I think, more on the MSME, which is a more structured MSME and the P segment, where it would have to be made available to everyone. For corporate, I think in any case, the Kamath Committee report come. So it was more on that. And there we are ready. We are already working on that. But for the corporates, it will be basically dependent on the default. So corporate, if he is able to generate enough cash flows by the time his dues, I mean, he has a due for repayment, till that time he doesn't need to come for restructuring, isn't
Absolutely.
it?
Yeah.
It's like, so there are a few, of course, always there'll be a few SMAs, and not all of them, we have talked to them, not all of them are interested in a restructuring, that they will generate enough cash flows, but some new ones may also come.
But this is as of the 8th of September, and not we can't really predict what the rest of the year is going to look like.
8th of September, as reasonably for 30th September, I can say.
Right.
And 30th September, I have given you clarity that it is going to be March. Even for December, very frankly, because we have an idea about our book. So I am not personally expecting any major account to come into any difficulty, given the way they have managed COVID, etc., either in December or even in March 2021. But we will have to see how it goes.
Right, sir. Right. Thank you so much, Mr. Basu, for joining us and giving us that amount of clarity. It's always good to speak with you. And thank you so much for joining us and watching this program.
Thank you. Pleasure.